Here is a question that sounds insane on the surface. What if you had the worst possible timing as an investor? What if every single time you invested money, you did it at the absolute peak, right before the market crashed? The dot-com bubble in 2000, right before it collapsed. The housing crisis in 2007, right before the worst crash since 1929. COVID in February 2020, right before markets fell 34% in 5 weeks. If you had somehow managed to pick the single worst possible moment to invest, every single time for the last 25 years, how much money would you have lost? The answer, and this is backed by actual research, is that you would not have lost anything. You would have made money, significant money. Today, we are going to run through exactly what this research found, why it is one of the most important things any investor can understand, and what it actually tells you about the single biggest mistake most people make with their money. Here is the fear that keeps millions of people out of the market. What if I invest right before a crash? It is the single most common reason people delay investing. Not lack of money, not lack of knowledge. Fear of timing. Fear of buying at the top. Fear of being the person who invested the week before everything fell apart. And that fear is not irrational. The market does crash, sometimes dramatically. The S&P 500 fell 57% between 2007 and 2009. It fell 49% between 2000 and 2002. These are not small events. Real people lost real money in real time. But here is what that fear gets wrong. It focuses on the moment of the crash and ignores everything that happens after it. And what happens after every single crash in recorded market history, without exception, is eventually a recovery to new highs. The research on worst-case timing does not just suggest this, it proves it, with specific numbers across specific periods tested against the most brutal market conditions of the last century. The most well-known version of this research comes from a thought experiment published by a Schwab researcher, and it has been replicated and verified multiple times since. Here is the setup. Take an investor. Call her the world's worst timer. Every year for 20 years, she receives $10,000 to invest, and every single year, she manages to invest it at the single worst possible moment, the exact day the market peaks before a major decline. She invests in January 2000, right before the dot-com crash erases 49% of the market over the next 2 years. She invests in October 2007, right before the financial crisis takes the market down 57%. She invests in February 2020, right before COVID crashes markets 34% in 5 weeks. Every single investment is made at the absolute worst moment possible. Now, what happens to her $200,000 in total contributions over 20 years? Remember the question from the beginning of this video. How much would she have lost? Despite investing at every single market peak, her portfolio is worth over $320,000. She turned $200,000 into $320,000. With the single worst possible timing, every time. And here is the detail that makes this even more striking. The research compared her results to 3 other investors. One who invested a lump sum immediately every year. One who spread contributions evenly throughout the year. And one who never invested at all and left everything in cash. The immediate investor did the best, ending with the most money. The dollar cost averager did second best. The worst timer came in third. But the person who stayed in cash, waiting for the right moment, afraid of bad timing, ended up with the least of everyone. Less than the investor with the worst timing in history. Here is why the worst timer still wins against the person sitting in cash. Markets trend upward over time. The S&P 500 has delivered positive returns in approximately 73% of all calendar years since 1928. That means in roughly 3 out of every 4 years, the market goes up. When you stay in cash, waiting for the right moment, you are statistically more likely to be buying at higher prices later than lower ones. Because the market's natural direction is up, every month you wait to invest, the odds of getting a better entry point actually decrease, not increase. Vanguard's research puts a specific number on this. Investing a lump sum outperforms dollar cost averaging 64% of the time over 6 months. Over 36 months, it outperforms 92% of the time. And Investing.com's analysis of the data from 1926 to 2022 found something even more striking. Even investors who lump sum invested at market peaks before major crashes, the absolute worst timing scenario, still outperformed dollar cost averagers over subsequent 20-year periods. An investor who put everything in right before the 2008 financial crisis, the single worst entry point in a generation, was ahead of a dollar cost averager by 2018. 10 years of patience, and the worst timer won. The mechanism behind this is time in the market. Every crash in recorded history has eventually been followed by a recovery. The exact timing of the crash does not ultimately matter as much as whether you were invested during the recovery. The person sitting in cash, waiting for the right moment, misses both the crash and the recovery. They experience the fear without any of the long-term reward. Northwestern Mutual's research team tested this across rolling 10-year periods. Investing a lump sum immediately outperformed dollar cost averaging nearly 75% of the time, regardless of asset allocation. Time in the market, every time, beats timing the market. Here are the 3 real conclusions from this research, and what each one means for a decision you might actually be facing right now. Conclusion 1. If you have money sitting in cash right now, waiting for the right moment, the research says the right moment is almost certainly today. Not because the market cannot fall further. It can, it might. But the research is unambiguous that staying in cash while waiting for a better entry point statistically produces worse outcomes than investing now, even at a bad moment. The exception is money you genuinely need in the next 1 to 3 years. That belongs in a high-yield savings account, not the market. But long-term money, 5 years or more, sitting in cash is almost certainly costing you more than a market crash would. Conclusion 2. Market crashes are not the threat most investors think they are. They are uncomfortable. They feel catastrophic in real time. The worst timer in the research watched her portfolio drop dramatically multiple times before recovering. That experience is genuinely difficult and requires real psychological resilience. But the data shows that staying invested through those drops, without selling, produces dramatically better outcomes than trying to sidestep them. The loss only becomes permanent if you sell during the decline and fail to buy back in before the recovery. Conclusion 3. And this is the one that changes how most people think about market news entirely. If even the worst possible timing still produced positive long-term returns, then watching daily market movements and trying to find the perfect entry point is not investing. It is a form of procrastination dressed up as strategy. The research does not say timing never matters. Immediate lump sum investing still outperformed the worst timer. But the gap between best timing and worst timing is dramatically smaller than the gap between any timing at all and never investing. The market will crash again at some point, with some specific trigger that nobody predicted clearly. And when it does, the investors who come out ahead on the other side will not be the ones who predicted it. They will be the ones who were already invested when it happened.
Here is what the research actually shows. The world's worst timer, investing at every single market peak before every major crash for 20 years, still turned $200,000 into over $320,000. The person who stayed in cash, waiting for the right moment, ended up with less than anyone. Vanguard found that lump sum investing beats dollar cost averaging 92% of the time over 36 months. Investing.com found that even worst-case timing investors outperformed cash holders over 20-year periods. Northwestern Mutual found lump sum beat dollar cost averaging in 75% of all rolling 10-year scenarios tested. 3 conclusions. Long-term cash sitting on the sidelines is almost certainly costing you more than a crash would. Crashes are not permanent if you stay invested. And watching for the perfect entry point is procrastination, not strategy. The best time to invest was 20 years ago. The second best time is right now, even if it feels like the wrong moment. If this video changed how you think about market timing and when to invest, hit that subscribe button. Every week on First Million Club, we break down exactly these kinds of real money questions with real research, so the fear of getting the timing wrong stops being the reason you never start.